We know that when people are entering retirement, it's a bit of a shift.
I think the starting point really is that the only certainty in an environment like this one is uncertainty. Then you can kind of quiet out a whole lot of noise, and then you can start looking at things in a kind of quiet, rational way.
It's a lot of information out there. The decisions that you're making can have very big impacts that you wouldn't necessarily know about if you're just looking quickly at a few words on this article and that article.
Let's say you're retired today, or you're retired 5 years ago or 5 years from now. Really, the starting point for me is that you have a wealth plan that says, what are you trying to accomplish with your money?
The Money Talk Podcast, brought to you by TD Wealth with Kim Parlee, recorded on April 17th, 2025.
Hello, everybody. I'm Kim Parlee, and welcome to the Money Talk Podcast. We're tackling a really big topic today. A lot of people really stressed out right now in terms of what's happening with the markets. And they're especially worried if they're coming close to big financial decisions, retirement. Maybe they're 5 years from retirement. Maybe they're into retirement. And it's tough to watch what's happening in the world and with the markets day to day. So today we're going to have a fact-based discussion on how you triangulate all that information that's out there and try and understand what the right thing is to do for you. So who better to have that conversation with than two of my favorite people? We have Brad Simpson, Chief Wealth Strategist at TD Wealth. He's joining us from out west, lovely Victoria. Brad, nice to see you.
Great to be here.
And Nicole Ewing, who is Principal of the Wealth Planning Office here at TD Wealth. Nicole, always nice to have you here.
Oh, it's a pleasure.
Okay, so I wanted to start with, for both of you, and probably, Brad, we're going to spend a little more time talking about the markets, and then we'll get into how it applies to people. But, the things that I've been hearing just anecdotally, friends, family, everyone out, people are like, these markets, like, they're killing me, or I want out, or, do I need to change my retirement plans? Some are like thinking maybe it's a huge buying opportunity. So you get the whole spectrum right now in terms of what people are looking at. And again, I want to talk about a fact. So I'll start with this. What are some of the biggest mistakes, Brad, that you see people doing in these kinds of markets?
I think the starting point really is you got to kind of get to the point of accepting that the only certainty in an environment like this one is uncertainty. And then if you do that, then you can kind of quiet out a whole lot of noise, and then you can start looking at things in a kind of a more kind of quiet, rational way. And I think that's a really terrific starting point is just accepting the noise, right?
Yeah. And I think, Nicole, I was going to say easily said than done, right? I mean, it's, because I say we're kind of at the beginning of all the uncertainty of what's happening. We could be doing this for quite a while.
Well, we could. And we think about retirement, for example, we're looking at planning for 15 plus years out and trying to do that, looking at the current state and anticipating what may happen. And that's part of the challenge, which is why we want to always think about all of the what ifs and think about the different scenarios, but be basing the decisions that we're making now with the expectation that we know things will likely change. So how do we best put ourselves in a position now to be able to both deal with the current state, but all the potential future states, what we could be encountering.
Okay. So Brad, let's talk a little bit about some of the historical context that we've seen. And you've written some great pieces that are out there. And so if people want the details, I know they can get into it. But and I know you've already, I don't actually know if this came from you, Brad, when you and I have talked before, but someone has told me is, it's not about predictions, it's about preparedness, right? That's what you want to build yourself for. So let's just start with, historically, what has happened during drawdowns? Like what have we seen versus what is happening now?
The starting point is that, right now, when you look at the financial market, the reality is that people are incredibly concerned, and you see all kinds of volatility out there. But I think you have to look at that volatility in a couple different ways. And the first one is that today what people are concerned about is actually more outside of financial markets, right? Like right now we have a trade policy that changes every day. And that trade policy and what's at stake is incredibly important to people, because ultimately it puts into play a potential for how we interact with other countries, how our economy interacts with other countries. And there is a real and justifiable fear out there about a recession, and ultimately recessions lead to difficult times for equity markets. And so because of that fear that's out there, I think what people are doing is taking this really unusual environment we're in right now and transposing that into the equity market. And so when I listen to people talk about the market and go, oh, we've had this unbelievable market correction and what carnage we've had. And it's like the tech wreck, or it's like the great financial crisis. And so I went back and I looked at it, and I looked at the returns of basically three areas, the big ones since 2000. And that was the tech wreck in 2000, the great financial crisis in 2007, 2008, and COVID. And I took the S&P 500 and I took the TSX and I compared the drawdowns from those three really significant market corrections, and I compared it to where we are today. And the reality is it's nowhere close to the sort of drawdowns that we've seen in that past. And I'm not saying by saying that is that it isn't possible that ultimately we could have a market correction that will look like that. But what concerns me about this is that using that language and having that fear in it, like, look, if you look at the tech bubble, the S&P corrected roughly about 47%. The TSX was about 45%. The great financial crisis, the S&P went down 57%. The TSX went down 47%. And the pandemic, the S&P went down 34%. And the TSX was about 37%. If you look at where we are today, the S&P 500 is down about 18%. Call it plus or minus a couple hundred basis points. Take a look at the TSX, the same thing. And you got to stop and look at that a little bit and go, boy, that we're certainly in nowhere within a million miles of the sort of thing that we've seen in those three really big tumultuous market environments.
The pessimist is going to say yet. I'm just going to say, because, I don't know if we're through. But to your point, again, this is not about predictions. This is about comparing what has happened. One thing that I know you've talked about as well is that this is a policy-driven slowdown versus something different. And maybe just, can you dig in a bit on that, just so we can get a better understanding of that?
So when you look at bear markets, and today, you could argue if we are in the middle of a bear market, they're defined as, a drop from the very high of a market to the very low of 20%. And we have seen that happen with some of the volatility that's gone out there. Now, when we look at that and you go, well, okay, then if you've had a bear market, what kind is that going to be? So there's three types. There's a structural one where that there's just something really fundamentally wrong inside the economy, and that we're in a really, really difficult position. And it takes an awful lot of time to go out and fix that economy to get things moving again. A cyclical one, which is somewhere in between an event-driven and a structural, is that it's impacted by something that has gone on during a current cycle or a shift in how the economy is functioning. But it's a shift, and it can be a kind of a medium-sized shift, if you will. An event-driven one is kind of like what we saw during COVID, for example. One day we were sitting there and everything seemed all pretty good, and then all of a sudden this talk of a pandemic hit, and all of a sudden we shut the global economy down, and the market went for a big correction. We did that correction ultimately to ourselves by shutting the economy down. It led to an equity market correction. The flip side of that is during COVID, the market bounced back up very quickly again because it was event-driven. It's really kind of similar to this one. We really have gone into this market correction right now. If we look at the United States, it was actually in really good shape. Economy was growing at 2.5%. Inflation had come back under control. We all had, remember the nightmares of the 8 to 10% inflation that we saw during COVID. But despite what you'd hear if you were watching hearing the news or reading in social media or a newspaper, inflation had actually got back to a much better place. And so the implementation of these tariffs really were a trigger point for this market correction that we're in the middle of. And that making it an event-driven one, if you look at it, your average event-driven correction like we're in now, they typically are about 8 months. And the amount of time after a event-driven bear market actually to make yourself whole in your equity portfolio, if you were in the S&P 500, is about 13 months, which I think is a pretty reasonable time horizon.
Another thing that you've written about, and wouldn't mind bringing Nicole into this too, is amygdala hijacking.
We have this little part of our brain that for most of our existence, when we were hunters and gatherers, that if we were wandering through a field and we saw that field start to rustle a little bit, it told us there was a danger there and told us to run. And, we as a species are incredibly fortunate that we have this amygdala. But, the bad news is that when we get afraid or we get concerned, we don't tend to differentiate. And so the other part of our brain is the cerebral cortex, which actually really acts as the Senate that needs to kind of curb that thinking. And so the important part really is that happens is that, you can literally do an MRI on somebody's brain and look at how your brain functions under a concern of on being physically attacked, but also how your brain interacts when there's a big market correction. And quite frankly, they actually inside your brain compute it in the exact same way. Now, why I'm explaining that is it's incredibly important because, one of the key to investment success is that first and foremost is that ups and downs of markets are actually what help make investing successful because it reprices things. And our ability to be able to override that hijacking, that fear that is there, is actually one of our key components to actually being a successful investor.
It's interesting with on that front because I'm thinking like we all have that. We're all watching the markets, Nicole, in terms of what they're doing right now. But then when you layer on top of that major decisions you have to make, you don't want your amygdala involved.
No, I love that idea. The Senate, the sober second thought of why we're doing what we're doing and how we're doing what we're doing. And when we're not just in the market environment, individuals are experiencing their own lives as well. And things can be happening to them that is completely unrelated to what's going on in the rest of the world. They could be, again, having to make decisions about when to enter retirement. They could be going through a relationship change, either getting into a relationship or exiting a relationship. They could be caring for parents and needing to figure out how to fund that. And maybe they're figuring out how to invest their parents' funds while they're doing all of this as well. So when we think about the decisions that people need to make and how their brain could be reacting to that, it reinforces the idea of let's look at the facts. Let's look at what's relevant to you, what you are trying to achieve. And that can narrow the universe of options for you in a way that you don't need to think about all of the potential things that could be happening or would be happening. But what is it that you're actually needing to do? What's important to you? What are the values that are important to you? And we know that when people are entering retirement, in any event, it's a bit of a shift from that savings mentality of growing your investments into the transition to the spend down. And we know that in all circumstances, that's an adjustment time for folks. So
I was thinking nobody wants to, that shift is hard. If you've spent all your time building it, then you want to spend it. But then layer on top of that you're worried about what's happening to the markets, it's going to be even worse.
Well, and there are important decisions to be made in terms of, for example, how to draw down and from which accounts, for example. So if somebody is making the decision between should I be taking my CPP, should I be taking my OAS early, or should I be delaying that so I get higher amounts later? Maybe I'm going to think about downsizing my home. And if I do that, and now I've used my principal residence exemption, I have this tax-free money, where do I put it?
I'm going to get into all this stuff because each one of those you just said, it's like I need to go deep on each one. But before I do, Brad, I wanted to ask you about the bond market, and then also just is this, what are you working with clients? I mean, is this an interesting time to be deploying capital into this market? And again, I know this all depends on the person and their situation, but your thoughts on those two?
Bond markets are a very, very different deal. Bond markets are unbelievably math oriented. At the end of the day, there is a maturity date on a bond. There's a coupon or a yield that you're paying to that maturity, and you ultimately know that it's going to mature and you're going to get your money back. Now, the most conservative place to put your money over the last 80 years since the end of the Second World War has been the United States Treasury bonds, and they are considered the safest investment in the world. And the currency, of course, the U.S. dollar is the reserve currency. It's been considered the safest currency in the world in which to hold your money. Today, after 80 years, and really at lock stop, I think you could look at 1971 when the United States went off the gold reserve, and other than that period, there has been very little question about the U.S. currency as that reserve currency and the safe place to be and owning a U.S. Treasury. Today, there's a little bit of trepidation in that, and I don't want to oversell this, but in the middle of really, which is an environment where how the world economic system has functioned for about 80 years, there is a pretty dramatic shift going on in that right now. And that dramatic shift is that one of the inputs is that typically in an environment when an equity market is going down, the yield on a U.S. Treasury bond starts to go down because people start investing. Remember, when you are buying and there's a higher demand for a bond, the yield will actually go down. What's been happening here is the 10-year Treasury, which is the main bond, is sort of the benchmark bond for safety in the world. Interest rates went actually up, and part of that is it a questioning mark? Is the United States still the safest destination for capital? Now, the answer for that is yes, but even the notion that we're asking that question, because if you look at Treasury bill auctions right now, there's a lot of demand for them. There's no liquidity problem in the Treasury market right now. The demand is high, but just that question onto itself, it is something that we just haven't talked about. And so because of that and a couple other inputs, there's a technical explanation that just shifts and liquidity shifts that are going on in the bond market right now have also had an impact. And also you've had there's a macroeconomic explanation that we wrote about, which really said is that, there's trepidation around deficits and inflation down the road. So that's also been reflected. And I think the most important part is our conviction really comes down to this, is that yes, there's going to be volatility in the bond market. We've actually written about that, and you and I, Kim, have talked about this on a number of our discussions in the past. We're going to see interest rate volatility in this new environment, and we are seeing that. But we still think that bonds are an excellent diversifier in a portfolio. And quite frankly, some of the yields that you can get from guaranteed U.S. Treasuries are pretty darn appealing here as well.
Can I ask just maybe just on the market side, Brad, just to sum up, again, if I'm someone who's, say, 5 years from retirement, or maybe I'm kind of moving along, I have retired, how should I be thinking about what's happening in the market right now? What are the kinds of considerations I should have in that situation?
Well, I think the starting point is frankly, either I'm going to steal a little bit from Nicole's playbook, or I'm going to say there's a reason why her and I are doing this podcast together, and that is really for me. If you look at it, I always say is that I'm the head of investment for a very human organization. All the areas that I'm the chief strategist for we're building investment portfolios for people, not for institutions. And, ultimately that's an incredibly different contrast between those two. To what Nicole was talking about earlier, institutions don't have bad days. They don't have divorces. They don't have weddings. They don't have corporate bankruptcies. They don't have companies that for families that go public and they have a big windfall. They don't have, children graduating from university. There's all those things that go on, and money is not an end in itself. It's a means to an end. And so I think the starting point is let's say you're retired today, or you're retired 5 years ago or 5 years from now. Really, the starting point for me is that you have a wealth plan that says, what are you trying to accomplish with your money? And usually I think, everybody's different, but I think you can break that down into kind of 4 different buckets. And the first one is when you have an environment like this one, where there's volatility in the market, but there's also volatility in the geopolitical sphere. There's fear and the first thing people go to is, what's my safety for my capital? I think what you do is you have to have part of your money invested in a let's use buckets, if you will, in a bucket where you have really short-term, really safe, really guaranteed investments, so that if something goes wrong for a few years, you have that capital that is there. I think you have to have a second bucket that goes that you have to fund your ongoing lifestyle, and part of functioning and managing that ongoing lifestyle is you need income, and that income needs to be, on one hand, it needs to be partially guaranteed, but it also needs to be able to be tax efficient. So I think you need to have a bucket where you're managing your portfolios irrespective of what's going on in the market right now, because over the longer term, the 5 to 7 and 10 years, that will be very different. And so you're managing part of that bucket is just for income and tax efficient income. I think you need to manage your money in a third bucket, if you will, is where you're going to need income 3 to 5 years from now. And that's more of a kind of a moderate growth bucket, if you will. And then the last part is that kind of that 15 year is like, that one of the things I think people have to think about is that if you retire at 65, when your life expectancies in your late 80s, so which means that you're going to have longer term funding needs. And you also have legacy things that maybe you want to invest in down the road. And so with that, I think you have to have part of your portfolio that is more growth oriented, and depending with your comfort level, aggressive growth oriented, where that can really compound and grow. If that's your starting point, all of a sudden, if you look at it, the environment that we're in right now, the part that's the biggest concern to you, you've actually already pre-planned for that, because you have in one of your buckets, really, you have it structured in a way that if no matter how bad it gets and how much volatility and risk there is, you've actually accounted for that. And so the rest is longer term, and you've invested it that way. And if you do that, you start there. Frankly, how we construct an investment portfolio around that, and based on those things, that's really what makes all the difference.
All right. Well, let's take that. And I consider this part, the first part of the conversation, the foundation. Thank you, Brad, of how to think about the markets and what's happening and how to structure. Now, Nicole, let's get into the personal stuff as Brad was talking about. And I've got a list of questions that come from people in terms of, what they're thinking about. So I'm going to run through them. One individual I was speaking with was like, do I need to change my retirement plan? That might be, I was planning on retiring at 65. Maybe it's 70 now because of what's happening. Just talk, when someone says that to you, where do you go?
So I think immediately of how comfortable were you with the assumptions that went into the plan that you had? How certain and were you about your spending habits, about the longevity that you were expecting the plan to need to provide for? I mean, if something's happening right now that is making you uncomfortable with the plan that you had, then I think that the answer is yes, you should revisit it. Mm-hmm. Either to make adjustments to the plan or to get a greater understanding of what that plan, what was used to build it for you. It could simply be that you're not aware of the what if scenarios that were done when that plan was generated. So we didn't assume just one set of facts going into the future. We assumed that a variety of things could be happening, that the markets could be doing really well at the beginning of retirement, that they could be maybe not doing as well, and that could change over a period of time. So I would suggest that if you are having that reluctance or that discomfort now, then absolutely go back to the plan. That's that you should be going back to the plan on a regular basis in any event.
I was going to say, I had that, and not that I planned this, but I actually revisited my plan yesterday when I was just speaking to somebody who was amazing. And just part of it is understanding. It's like, oh, you already took that into account. Oh, you already took that into account. So it was refreshing to hear that conversation. And then there were some other things, you can say, well, what if, and you go through. But some people might be, rethinking, and maybe not for plan reasons, maybe like they're changing where they want to spend their retirement now. Like that's a real thing that's happening right now.
We are seeing shifts in where people are anticipating spending their money and spending their time. And so whether that's spending time in Canada, maybe in different provinces, then it's an understanding of what your options are. So we used to see people thinking about maybe buying properties in other parts of the world or recreational properties, spending time down south, for example. there are things to think about and be aware of when you make those decisions. So, for example, if you were to want to own a property in Mexico, for example, there's certain ways that you would need to hold title that are different than the way that you would do that in the US or in Canada. And being aware of what those considerations are and who's involved then in your plan. It could be the governments of other countries now have an interest in your assets that they wouldn't have had you kept that money in Canada. The UK has recently changed significantly some of their taxation and their the rules around domicile. So we have people from all over the world who have been in Canada for some time, and those rules that have changed will change the way that assets are taxed. So if you have a recreational property in the UK, for an example, now those rules are going to impact perhaps what money's left over for your beneficiaries, for what tax implications will come on your eventual death. And then within Canada, we're seeing as well that money has a very different reach in different parts of the country. So if you had planned on spending significant funds maybe on a property somewhere else, and you're now looking at purchasing a property either out east or out west or in parts of Ontario, knowing how far that money will go for you, and really thinking through not just now, but how you're going to transition and maybe pass that property on to the next generation. Lots of things to think about.
Yeah, and there's lots of things to think about too. I would say, we just know anecdotally as well too, people are thinking about, selling properties now, in the US, and maybe just it's the loonie, right? The loonie is just not as powerful as it once was, although it actually has gained a little ground. It's gained a little ground, but that's even, excuse me, maybe not making a spontaneous decision on that front, like thinking that through in terms of what the implications are.
Oh, absolutely. I mean, we see that if you're selling property in the US, you have both Canadian and US tax implications for doing that. And depending on how much time you are willing to devote to that process, you may have different outcomes. So, for example, when a Canadian sells US property, there's withholding tax on that. And there's a process that you can go to depending on the value of the property. If it's less than 300, you can get that withholding tax down to 0. And if it's less than $1 million, you can get down to 10%, it's generally 15%. And you can make an application to have that amount reduced over time. But that, I'm hearing, can take 18 months plus to have that certificate approved by the IRS. Whereas if you are instead saying, I'm fine with the withholding can, we'll just pay it. And when I file my U.S. tax return, I can seek to have a refund of that amount have been, that's been paid. You can think about that as, again, liquidity that you have available to you to deploy for other uses. So if you're looking at a quick sale in the U.S., because you want to get the current market results for that, then you might have a different a time frame in mind than if you're looking at taking tax into consideration and not wanting to pay any more than you absolutely have to until the very last minute. That's going to extend the amount of time that you need to be thinking about for the sale.
I'm going down my list. So I'm thinking like people thinking about when they retire, thinking about where they might retire, inflation. I was, and when we were having a discussion as well, when I was speaking with my advisor and planner was, is that the right inflation rate? I mean, because things are all over the place right now.
And we think about the cost of living and just how much we are spending on things, that it's different than what we may have been spending before. And so, yes, we have the opportunity to look at what are discretionary expenses. Where can we make some decisions to either change our behaviors and not indulge maybe in the same things that we were before? And then there's others that are not discretionary, that these are just expenses that we're going to need to absorb and could be potentially significantly higher. We know this, for example, with long-term care. And we know that as we age and the life expectancy is much longer than it has been in the past, we need to be able to anticipate how we want to fund our lifestyle, what that looks like, what that feels like for us. And so it may be, this is about, when we look at the plan, we're looking at short-term and long-term. We may want to change our behaviors now and pull back a little bit on some of the discretionary expenses so that we have more funds available for discretionary later on. When are we going to be wanting to have a little bit more flexibility, a little bit more funds available to us Is it in the short term? Is it in the long term? And this is always a weighing of what's important to you.
But I think also, too, it's also understanding that, and I'm stating the blindingly obvious, but, if you don't use your money in the short term, it can work for you longer in the long term. And just people need to understand those trade-offs.
And we think about, again, funding your retirement and how you're funding it, where you're pulling your income sources from. So it's really, I think, valuable to step back and look at where you're pulling.
Well, let's talk about the income sources, because that's, you alluded to it, but I mean, the order, the sequence matters.
So it does matter. So we look at what's available to us. So for many people, that would be CPP, OAS. You may have a pension income from a private employer.
RIF.
You may have RIF funded and in your TFSA and your home, for example, as well. So there's a lot of different potential pools of money, and where you pull them from will have an impact. So if we think about the types of investments that you're earning, if you are earning those in a non-registered account, and you're receiving dividend income, right? That dividend income is grossed up for the purposes of your old age security. And so whether or not you're going to have a clawback on your OAS, it could be you're being clawed back on money that you didn't actually receive into your pocket. So it's taxable income that was impacting the OAS entitlement. And so when we think about, okay, what type of income am I pulling in, and does that have an impact on the other type of income or benefits that I might be entitled to? So we want to be mindful here of our tax brackets, of our marginal rates, of when we look at RIFs, for example, you have required minimum withdrawals that you need to pull that money out, whether you want to or not. Many people would prefer to let it just sit in the registered account, allow it to recover or grow or in that tax-free environment. But that's what a RIF is. It's income for retirement. So you've got to pull the money out.
But can you, and also, sorry, not to jump around, but when you pull the money out, can you choose when and how the money comes out? Like, is it all at once, or can you put little bits? I mean, it's like dollar cost averaging in reverse.
Well, so this is where, working with your advisor, it's essentially the yearly amount that needs to be pulled out. So you can work with them in terms of how and when it's coming out into your other accounts, but the amount that you must take out is determined based on your previous year's income.
Right.
So
I'm just thinking, in these big market events that are happening in the moment, maybe you choose to do it at a different timing based on what's happening. So,
and this is where, depending on what you are invested in, even within your RIF, you may or may not have that flexibility to do that. So if you are in certain types of illiquid investments, and this is why it's really important to think about not just the type of investment you're in, but the impact that may have. So we think about TFSAs, for example, and some people use the TFSA as an opportunity to maybe play a little bit. This is money that they're going to be able to pull out. But if you're suffering losses in there because maybe you went a little bit more aggressive than you realized you were going, or there's volatility that you hadn't factored in, and you were seeing only the growth potential there, now you have losses in your TFSA
that you can't use,
that are useless. Right? That they're just sort of locked in there, and now you're not in a position where, had you held those sorts of investments in a non-registered account, you would be able now to use those losses against gains, not only this year, but the previous 3 years. So we're looking at we don't look at just one moment in time. We're looking at a time frame that we're able to move income and assets and tax benefits or strategies around.
I didn't want to, sorry, I was going to say, so again, so order of your income, where you get it from, just, these are the kinds of conversations you're already having with an advisor. They're thinking about these things and have been thinking about them for a while. You talked about longevity. I want to talk about big transactions too. Like as one of the ways some people fund retirement is they make big sales of things. They're a business owner, they sell their business. And again, these are not overnight decisions. These are years in the making often. But in this environment, how do you think about that?
Oh, gosh. Well, again, hopefully it is all part of a broader plan that you've been thinking about, not just today. And for business owners, generally, we're looking at least a couple of years if there's going to be that transition event where you're either selling to a third party or you're transitioning to your family. Now might be a great time if you're feeling that the values of your business are a little bit depressed, but you're expecting those to go up in the future. Now might actually be a great time to transition that over to the next generation. Yeah, able to freeze in the value in today's dollars. You are transitioning the business over to the next generation at a time where you anticipate that the upward growth is going to be even more significant than it may have been previously. If you're riding the highs, then you're locking in your tax liability at that high rate. And so instead, if we are seeing that there has been a decline, maybe in the value of your business temporarily, that may actually be an opportunity for you to think about transitioning in a really tax efficient way.
Okay, let's talk a bit about as well for people who are, maybe you're assisting others in management of
which many people are.
players. Yeah, like I was going to say, if you think older adults are working with their parents, I mean those things too. And I think even understanding, and I'm stealing from you, but you talk about like understanding their risk tolerance, like not making decisions on their behalf on risk tolerance. It's complicated.
Oh, for so many reasons. This is important. So, of course, making sure that they're appropriately invested is important for them, and that you understand the relevant factors based on their circumstances. But there's also, broader things that we need to think about. If you are acting as an attorney for property, for example, or a guardian of another individual, you have a legal obligation to be invested in a way that's appropriate for them. And you may be held personally liable if there are, significant losses or the funds are not being, having the returns even that would be appropriate for them. Because you are not invested properly, you could be held liable for that. So it's important. One of the ways around that, one of the ways to prevent being personally exposed in that situation is to work with a professional, is to show that you have done your due diligence, that you have brought in those experts who are able to provide the great insights that Brad and others are, bringing to the table, that you are then protected with that reassurance that you have taken their considerations, their circumstances are paramount. This is really tough for people to think about, particularly if you have direct access to their accounts and their investment decisions. And it may be tempting for you you want them to get the very best results. I'm not suggesting in any situation that this is not, that they don't have the best interest of that individual in mind. But we need to be thinking about, different time frames, different life expectancies, different health situations, different expenses, different needs for money. So as we talked about, if those funds are locked up because you were trying to get a certain result, but there's an immediate need for that cash flow, that's something that you need to think about. And how are you going to be supplementing that and funding that? And that's just not an ideal situation to be thinking about.
I want to one more quick thing on tax loss selling. I mean, you mentioned also what happens if you have losses in a TFSA. Too bad. But that tax loss selling is something also people should be thinking about also in this environment. It might be something that's really beneficial to them.
Sure. There's certainly circumstances where this would be an appropriate thing to be thinking about right now, where the value of your, of your investment has gone down, and you can see that if you sell this now, you can crystallize that loss. You can use that loss again to reduce the income in the previous 3 years. So you're filing your returns and getting those funds back to be able to then deploy. You can carry it forward, and you can reinvest immediately in similar investments to still benefit from what we anticipate would be the upward growth on that. Now, we need to be, again, mindful as always about the broader circumstances. So this is where you want to be coordinating with your spouse. If they are doing some very active decision making at the same time, this is where we get into the superficial loss rules, where if you were to sell and then immediately repurchase the identical property, and or your spouse does that, your losses can be denied, and that's obviously going to defeat the purpose of that strategy.
I want to bring Brad back in, and because there's we're kind of covering a lot of ground in terms of all the things we can think about, Brad, and same with you in terms of the market. And Nicole, I actually was looking at some of your notes, and you talk about unforced errors, and I think, Brad, you would probably agree with that idea that you don't want to have these right now. So if we were just to sum up, and I was going to say, if someone, is fast forwarding on this podcast and they're listening to the very end, Brad, I'm going to ask you first, when you kind of use that unforced errors idea, what are the core things you want people to think about in 30 seconds?
Look, I think the starting point is that I think a really good thing to do right now is step back and look at your investments and investment success ultimately comes down to is asset allocation and how you're allocated. And so, if from our beginning part of what we discussed today, if that we really have gone through a market correction, but not a really significant one, there's ample opportunity here to review your investment portfolio, because I think a lot of Canadian investors actually have an investment portfolio that were built for an environment that has changed dramatically in the last 3 years, but the way they've allocated hasn't changed. So I think the starting point by here would actually be to step back, make sure that you have a portfolio that is well diversified, but constructed for the world that we live in today and the one where we're going to, because I think a lot of folks actually aren't invested that way. And I think if you do that, and then move forward with making sure that taking that investment portfolio that has well allocated with fixed income investments, a well diversified equity portfolio, but also making sure that you have some alternatives there. So owning some private capital of some sort, making sure that you have some commodities there that is good for diversifying geopolitical risk. And also making sure that you can understand that you can use hedging strategies to be able to protect capital as well. And I think if you do that and then stick it and make sure that it links to your plan, I think you do that, I think you're going to be in pretty good shape.
All right. I can see Nicole nodding. From your perspective too, building on that unforced errors from that standpoint, how do people think about things?
Making sure that you understand why you are invested the way you are, why you have the goals that you have, and being able to define those clearly will prevent you from being reactionary in situations where oftentimes it comes from uncertainty. That feeling of uncertainty sort of translates into decisions that lack that certainty. So working with professionals who understand the markets, who understand your goals, who understand what you're trying to achieve, and know what levers to pull and when will prevent you from perhaps making a decision that would put you in a situation that is not ideal for you, and maybe miss out on some of the opportunity that's actually available to you. Regardless of what's going on in the rest of the world, there's always an opportunity to more appropriately help you make decisions that are appropriate for you and not just be reactionary to the others. I think that's bottom line.
Last question for both of you. Brad, is there anything that we haven't talked about that we should talk about when you think about who we're talking to?
No, I don't think so. But for me, I'd want to reinforce one, I think, important thing, and that is I believe that as an investor today, you've never been confronted with the way we consume information, the way algorithms work, the way we do a search through social media, and how we often do a search on our biggest fears. And then those biggest fears get amplified and come back to us over and over again. As a species, we've never dealt with technology the way we are today. And I think being mindful of that, it can act as a real governor in how you think about things. And if you do that, I really do. I think that's going to make a world of difference.
Are you watching how I doom scroll? I want to know that, Brad. Is that something you're seeing? Nicole, same for you.
I want to double down on what you've said there, Brad, because that's the key. There's a lot of information out there. Some of it may be current, some of it may not be. Some of it might be applicable across the nation. Others is going to be really relevant in the province that you are in. So when we think about all of these decisions that we're making, tax, yes, is generally the same across the country, but things like family law, estate law, that's all very provincially specific. And the decisions that you're making can have very big impacts that you wouldn't necessarily know about if you're just looking quickly at, a few words on this article and that article, or pulling together some searches that you've done. It really is important to consider the source of the information to make sure that that is true and current and applicable to you in your province today.
All right. Well, I'm coming to both of you as my sources. So I'm going to say you're both pretty sound. Thank you so much. It was great to have you both here.
Oh, my pleasure.
Thank you.
Thanks for tuning in to this episode of the Money Talk Podcast, brought to you by TD Wealth. The information contained herein has been provided by TD Wealth and is for information purposes only. The information has been drawn from sources believed to be reliable. The information does not provide financial, legal, tax, or investment advice. Particular investment, tax, or trading strategies should be evaluated relative to each individual's objectives and risk tolerance. The views expressed are those of Nicole Ewing, Principal Wealth Planning Office, TD Wealth, and Brad Simpson, Chief Wealth Strategist, TD Wealth, as of April 17, 2025, and are subject to change based on market and other conditions. Certain statements in this presentation may contain forward-looking statements that are predictive in nature and may include words such as expects, anticipates, intends, believes, estimates, and similar forward-looking expressions or negative versions thereof. Forward-looking statements are based on current expectations and projections about future general economic, political, and relevant market factors, such as interest and foreign exchange rates, equity and capital markets, the general business environment, assuming no changes to tax or other laws or government regulation or catastrophic events. Expectations and projections about future events are inherently subject to risks and uncertainties which may be unforeseeable. Such expectations and projections may be incorrect in the future. Forward-looking statements are not guarantees of future performance. Actual events could differ materially from those expressed or implied in any forward-looking statements. A number of important factors, including those factors set out above, can contribute to these digressions. You should avoid placing any reliance on forward-looking statements. TD Wealth represents the products and services offered by TD Waterhouse Canada, TD Waterhouse Private Investment Council, TD Wealth Private Banking offered by the Toronto Dominion Bank, and TD Wealth Private Trust offered by the Canada Trust Company. TD Wealth Private Wealth Management represents the products and services available through TD Wealth Private Investment Advice, a division of TD Waterhouse Canada, TD Wealth Private Investment Council offered by TD Waterhouse Private Investment Council, TD Wealth Private Banking offered by the Toronto Dominion Bank, and TD Wealth Private Trust offered by the Canada Trust Company. The TD Wealth Asset Allocation Committee is comprised of a diverse group of TD investment professionals. The committee's mandate is to issue quarterly market outlooks which provide a concise view of the upcoming market situation for the next 6 to 18 months. The committee's guidance is not a guarantee of future results, and actual market events may differ materially from those set out expressly or by implication in the committee's quarterly market outlook. The Wealth Asset Allocation Committee Market Outlook is not a substitute for investment advice. The TD logo and other TD trademarks are the property of the Toronto Dominion Bank or its subsidiaries.